Most business owners wait until there's a cash crisis before diving into their financials, but by then, it's usually too late. But imagine if you could see the problems coming weeks or even months in advance just by knowing what to look for in the reports sitting right in your inbox right now. At Proseer, we've worked with hundreds of businesses between $2 and $20 million in revenue, and I can tell you that most successful ones have one thing in common. They understand what their financial statements are telling them. By the end of this video, you'll know exactly how your balance sheet is organized and which numbers actually matter, the 3 key indicators that instantly reveal your business health, how to spot dangerous trends before they impact your cash, and the one section of your income statement most business owners completely misinterpret. Make sure you stick around to the end, where I'll share a simple 3-minute review process you can use each month to stay ahead of any problems. And if you want more practical financial tips like this delivered weekly, hit that subscribe button now. Here's the reality. Many accounting reports aren't designed for business owners. They're created for bankers or tax authorities. No wonder they can feel confusing. It's like trying to drive a car by looking at the engine diagnostic report instead of the dashboard. Today, we're going through a simple framework so you can stop guessing and start making confident decisions based on what your numbers are actually telling you. Let's start with the balance sheet. Think of it as a snapshot of your business's health at a single moment in time. Your balance sheet is organized into 3 main sections. Assets. These are things your business owns. These are listed in order of liquidity, meaning how quickly can they be converted into cash. Current assets like cash and accounts receivable are at the top because they're already cash or will become cash within a year. Fixed assets like equipment and property are below because they can take longer to convert to cash if you need to. Now let's talk about liabilities. These are things your business owes. Like assets, these are organized by timing. Current liabilities are what you need to pay within a year, like accounts payable, short-term loans, or credit cards payable. Long-term liabilities like mortgages or equipment loans are below that. The last section of the balance sheet is your equity. This is what's left for the owners after all the debts have been paid. This includes your initial investment plus all the profits you've kept in the business over time. Now here are the specific numbers to focus on. First is a number called your recurrent ratio. This is simply your current assets over your current liabilities. This metric tells you if you have enough short-term resources to cover your short-term obligations. For example, a current ratio of 1.5 means you have $1.50 in current assets for every dollar in bills coming due soon. Anything under 1 can mean that potential cash problems are ahead. Next, if you have accounts receivable, I recommend you look at your accounts receivable aging. This report breaks down how long customers have owed you money. For example, if you see a growing percentage in the 60+ days column, that's an early warning sign that cash collections are slowing down. And here's something you might not realize. The balance sheet is where problems show up first, often months before they hit your bank account. But the income statement is where we find the causes, which is exactly where we're going next. Let's talk about your income statement. Your income statement might look complicated, but it's actually telling a simple story about how money flows through your business. The income statement is organized in a top-down format. Revenue, money coming in, cost of goods sold, which are direct costs to deliver your product or service, then gross profit, which is what's left after subtracting cost of goods sold from your revenue. Then we have your operating expenses. These are overhead costs like salaries, rent, insurance, software subscriptions, and other things that don't change based on how much money you make. After you subtract the cost of goods sold from your gross profit, you get your net income. This is what's left after all the expenses. Now, if you're like most people, you're focusing on your revenue numbers, but this isn't the most important number. Outside of your net income, your gross profit will tell you a lot about your business. This is what's left after direct costs, and it tells you if your core business model actually works. For example, if you run a law firm and your gross profit percentage, that's gross profit divided by revenue, drops from 65% to 60%, it can mean a couple things, like your associates aren't maintaining their efficiency, your case mix has shifted towards less profitable practice areas, or you're putting off too many billable hours when invoicing clients. This simple percentage change is an early warning sign that something in your core service model needs attention. Here's a tip. Track your gross margin percentage month over month. Even a 2 to 3% drop can signal serious problems with purchasing, pricing, or production efficiency. Now let's talk about how the balance sheet and income statement work together to reveal trends that predict your future. But first, let's talk about what these numbers actually mean in plain English. Let's go through a trend analysis technique. The real power comes when you compare these statements over time. This is called trend analysis, and it's like having financial X-ray vision. Start simple. Compare this month to the same month last year. This eliminates seasonal variations and shows your true growth or decline. For example, if you run a retail store, comparing December to November might not tell you much because December is naturally busier due to holidays. But comparing this December to last December shows you year-over-year growth. Next, Look at 3 consecutive months. Are things getting better or worse? The direction is often more important than the actual numbers. And here's something counterintuitive. Sometimes negative numbers are actually positive signs. For example, if you see inventory decreasing while sales are increasing, that's usually good. You're getting more efficient with your inventory management. If you're a service business, seeing your accounts receivable decrease while revenue increases could mean you're getting better at collections. Let's put it all together with some practical examples of how these metrics connect. So what we're gonna do is we're gonna go through how financial statements can reveal hidden problems or opportunities. For example, imagine a construction company that notices their gross profit margin dropping by 3% over 3 months. Digging deeper, they might discover that material costs have increased, but they haven't adjusted their project quotes accordingly. By updating their pricing model based on this information, they could immediately improve profitability on their new contracts. Or consider a software company that sees their accounts receivable steadily growing faster than sales. This could indicate that clients are taking longer to pay, which might lead to future cash flow problems. By implementing an automated payment reminder or adjusting payment terms, they could improve their cash position before a cash crisis occurs. And that's the key insight. Your financials aren't just telling you what happened, they're telling you what to do next. In the last minute, I'm going to show you exactly how to implement this in your business with a simple monthly routine. Here's your simple 3-minute monthly financial review. Step 1, check your current ratio. Is it above 1? This tells you if you have enough short-term assets to cover your short-term obligations. Step 2, compare your gross margin to last month and the same month last year. Is it stable, improving, or declining? Step 3, look at your top 3 expense categories. Are any growing faster than revenue? For example, if your revenue grew 5%, but your marketing expenses grew 15%, that deserves investigation. Now, what do you do when you spot a concerning trend? Don't panic, investigate. Almost every financial problem gives you a warning sign 3 to 6 months before it becomes a crisis. Do this simple review once a month and you'll catch problems while they're still small enough to fix easily. So there you have it. A simple way to read your financial statements that actually helps you run your business better. We've covered how to understand your balance sheet, what really matters on your income statement, and how to spot trends that predict future problems. Your action step for today? Pull up last month's financial statements and try the 3-minute review we just talked through. Notice anything surprising? That's the power of financial clarity. If you found this helpful, be sure to check out our other videos where we cover best practices for business owners on tax planning, accounting systems, financial management, and other strategies to help you build a more profitable business. And hit subscribe so you don't miss out on any of our weekly tips for making your business more profitable and less stressful. Thanks for watching.